Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is a special edition where we're going to be focusing on the macro trends that are shaping up across the globe and what are the big expectations back home in India. We're going to be talking about how the US Fed has taken a decision to cut the rates for the third time in a row, slash the interest rates by 25 basis points, and with that, for the entire year 2024, the Federal Reserve has lowered the rates by a full percentage point. What's more is that they've also indicated that there could be two more rate cuts coming in the new year, that's 2025. Although that pulled down the stock markets globally because there was an expectation that at least there could be 4 rate cuts happening in the US Fed. But this has also pulled up and put all the eyes on the central bank back home, on the RBI, to see as to by when will we see a rate cut cycle begin back home in India, and whether it is going to be a tough road for the RBI to decide on the same from here on. To discuss and to decode the macro trends, right now we have two special people joining in on the panel discussion today. We are welcoming Mr. Indranil Pan. He is the Chief Economist at Yes Bank, and we also have with us Mr. Sunil Sinha, the Economist as well. Warm welcome to both of you. Thank you so much for taking the time out for this special discussion. Mr. Pan, I will begin by understanding from you. First, your key takeaways from the US Federal Reserve's decision, as well as on the outlook that they have given, 2 rate cuts instead of 4. What does it really mean for the macroeconomic trends which will shape the global market trends too?
Well, I think everywhere central banking is becoming a challenge. Number one, from the US perspective, labor markets continue to be stronger than expected. Inflation is not coming down with the same pace as they had been expecting earlier. And if you look at the economic projections that have been put out by the Federal Reserve, they have increased the GDP numbers, they have reduced the unemployment rates, and they are looking at inflation being higher not only in 2025 but also in 2026. So, given that situation and given the sort of likely, though explicitly this has not come into the forecasts, but obviously we are looking at an inflationary Trump regime, which includes a sort of fiscal push and which is likely to keep rates on the higher side. So, all taken together, the Fed is now pruning down the extent of rate cuts that one should be expecting in the next year from 400 basis points to just 50 basis points, which definitely has its implication on the emerging market economies, central banks who had been looking to cut rates to boost their domestic growth.
Absolutely. Let me bring in Mr. Sinha also to add on to the same point as well. Mr. Sinha, were you disappointed with the way the US Fed has rolled out this policy decision, the latest one at that, especially on the outlook on the rate cut front? And do you really think this is going to make the decision back home for the RBI to cut interest rates more difficult?
Well, so far as US Fed is concerned, I mean, obviously, US Fed's decision will be dependent upon their assessment of the overall macro situation and the way they have been tracking the high frequency data. So against that backdrop, obviously, as Indranil pointed out, the way they had expected inflation to soften, that has not happened. And at the same time, the geopolitical situation remains pretty volatile. So under that situation, obviously, some tweaking had to be done, and the Fed has done that by giving a guidance that instead of 4, now they will be going for 2 rate cuts. But at the same time, we also have to understand that what will be the quantum of those rate cuts? Is it going to be a baby step, or is it going to be
Yeah.
the bigger one? I mean, that will ultimately decide the contour of the rate cuts in 25. Now, all of this certainly has some implication for emerging economies like India. because ultimately, the capital flows are an important component which can, have an impact on the overall economic growth. So in that context, yes, I mean, the guidance which has come out now will certainly make the job of RBI somewhat difficult. But at the same time, we also know that much of the policy making, apart from the global scenario, also depends on what happens to the inflation in the domestic market. And here again, I mean, the overall trajectory is not very comfortable so far as inflation is concerned. So, in my view, RBI will have a tough job ahead, and rate cut will happen only if the projection or the expectation that RBI has about the future rate of inflation is somewhere coming down to 4%, if not in the second quarter, third quarter, or fourth quarter of this fiscal year, but certainly how it will shape up in the next fiscal will ultimately guide the RBI policy making.
Sure. We'll circle back to what the RBI will do, going forward as well. But I just wanted to pull one more string with, Mr. Pan as well, as far as what the US Fed has done and how the markets are now going to be perceiving the next two or couple of moves from the US Fed, and how is that likely to impact the foreign flows. I mean, we were of the hope that probably Indian markets will give them a better chance. But at the same time, is there a concern that the US debt market with more attractive returns will become a stronger alternative for the foreign flows? How do you anticipate that to be shaping up, sir?
Well, I think you've made the point any which ways. I think the FPI flows have been weaker. The concern also is that domestically you don't have too much of a significant pull in terms of profitability that is visible immediately, given the fact that we are also under a likely slowdown in terms of the purchasing power and the general sort of the personal consumption expenditure, so to say. So that is one part of the story. The other thing is that, again, sort of linking it back to the interest rate cycle, I think what Sunil also pointed out is that the RBI has a very tricky job at hand. On one side you have the growth slowing down, and the other side inflation is relatively still sort of sticking and holding on, though there is a big expectation that inflation will come down as you see the winter months going through. But having said that, I think they have to keep their eye on the currency, no doubt. And any sort of softening in the interest rates domestically will open up the wedge further, which is already there between the US yields and the domestic yields. So if US yields rise further and if the domestic yields are lower, that I don't think is a good scenario in terms of the debt flows that we are looking at. And to that extent, I think even the ECBs, if the interest rates in the global atmosphere, especially the US, your 10-year is already at 453 levels, and there are expectations that as inflation remains sticky and as the indebtedness in the economy increases, the US interest rates, the 10-year could actually rise to 460 to 480 levels. That will severely hurt the appetite of even ECB flows and FDI flows into the economy. So again, my last point is that we have been sort of thinking and patting our back on the current account balances being very low at 0.7 last year and expected at around 1.5, 1.1% this fiscal year. But the critical risk today lies in terms of the capital account balances, even with the lower current account.
Okay. Let me get Mrs. Sinha yet again, especially on the currency issue as well. What do you think the RBI's thought process will be on the continuous weakening of the rupee? How much room do we have to protect a further fall from here on? What is it that will further exert pressure within the current macro trends that we are seeing right now? And how do you see this space emerging, sir?
Well, I mean, weakening of rupee has been happening, and as we all know that
Yeah.
there has been a significant outflow of the capital from emerging economies, including India. So all of that obviously has made Indian rupee, weaker against dollar. But this is a trend not only vis-a-vis Indian rupee. I mean, several other emerging market currencies have also weakened, and for the same reason. And so far as RBI is concerned, I guess RBI has time and again indicated that their intervention in the forex market is more to stabilize the dollar rupee rate rather than really bringing or pegging the rupee at a certain level. And in any case, we have seen the outflow of capital in the recent month, leading to our forex reserve dropping from a little above 700 billion now to close to 650 billion dollars. So in any case, the RBI intervention in the rupee dollar market will be very minimal, and it will be more to stabilize the market than to really guide the market. And much would of course depend on the market forces. And here again, I mean, with the coming in of the Trump administration in the month of January, one really doesn't know how much of its impact will be felt on merchandise exports, because most of the statements are not very favorable so far as India is concerned. Only recently, Trump said that Indian tariffs are
Yes.
very high, so we need to really look into that, and so on and so forth. So overall, if our exports remain under pressure while stickiness of import continues, especially the oil imports, then somewhere the current account deficit is likely to widen further. And as Indranil pointed out, if the capital account is also not sufficient to cover up the current account, then one can expect further weakness in the rupee.
Absolutely. Coming back to Mr. Pan, then on something that you pointed out, Mr. Sinha, which is very valid at this point in time, a major concern as well. Weakening of the rupee, further making oil imports costlier for us, and further adding to the imported inflation, domestic inflation with respect to food already being high. There has been some softness, but there are others as well. And now with imported inflation further hiking, probably propping up further, do you think it will cause further trouble for the RBI then to decide upon maybe a February rate cut that was earlier being anticipated?
Well, I did point out to the fact that the rupee is a problem, and rupee, irrespective of how much implication it has for the inflation, a sharply sinking rupee is possibly not the right atmosphere for any central bank to cut rates, because as I said, it widens the gap between the domestic interest rates and the foreign interest rate, and can sort of therefore pressure further outflows from the system. Having said that, I think the other point that we need to also understand and realize is that China has still not launched its own fiscal stimulus, which it had been almost promising. And my opinion there is that probably they are waiting for the extent of the hit from the Trump tariff. What is the extent of tariff that actually hits them, and what is the implication of that, therefore, in terms of its own growth process? And that is the point in time possibly they will actually come out and launch its fiscal easiness into the system to prop up the economy. Now, my opinion there is that what it also does, along with the currency depreciation that we just talked about, actually opens up room for the commodity markets, the hard commodities, the industrial commodities, to actually climb higher. And that, I think, will be a bigger risk for inflation domestically than only sort of talking at the currency depreciation. Because as Mr. Sinha also pointed out, the RBI still does have room to actually contain the depreciation pressures to some extent. So I think it's a very sort of mixed bag for the Reserve Bank of India at this point in time. And my biggest point is that before launching itself into a rate cut scenario, they would possibly need some more time to understand this whole sort of bouquet of issues that are coming up, especially from the global economy. And let us also not forget that there is a net wealth erosion that is also happening in India, which also has its implication in terms of the growth process. So the growth inflation balance is something that the RBI needs to be very carefully addressing at this point.
Absolutely, very valid point right there. So, Mr. Sinha, let me come to you on the growth inflation balance then. Considering the fact that we have grown at the lowest pace in the last 21 months odd, and with these new pressures of how policies will be shaped up January 20th onwards in the mother market, that is US, there are further concerns of whether we could slip further from here or will there be a recovery? What is your sense right now, given the kind of macro trends that are at forefront?
Well, certainly the second quarter data, GDP, I mean, GDP data for the second quarter hasn't been very encouraging. Although some high frequency data, when you look at in the third quarter, they are indicating that the overall GDP growth in the third and the fourth quarter may be somewhat better than the second quarter. But overall scenario is what was summed up by RBI in the sense that they have lowered the overall GDP growth projection from 7.2% to 6.5%. Which clearly indicates that growth slowdown is very much visible. And even going into the next fiscal year, I mean, given the kind of geopolitical situation we are in and the kind of stickiness that we are witnessing so far as inflation is concerned, and also the fact that much of the growth slowdown is due to the slow growth in the private final consumption expenditure, which is the largest component of GDP from the demand side. So all of these are not very healthy indication for how the immediate future looks like. So it will be a tough job for RBI. But my own opinion is that RBI will not be in a hurry to really go for a rate cut just because there has been some growth slowdown and there is a murmur, across the board to really do something in terms of rate cuts, etc., to support the growth. But I think the bigger challenge is that, inflation is something which always needs to be anchored if you really want growth to progress in a more sustained and expected manner. So RBI, in my view, will still, look at the incoming data. They will take a call on exactly how these data is, behaving and what is the likely trajectory, particularly of inflation. And so on and so forth, and then only it will. So let's not hope that there will be a rate cut in the February review meeting. My own sense is that this will, if at all has to happen, it will spill over to the next fiscal, not before that.
Okay. What is the quantum that you would expect if there is a cut?
Well, my view would be that RBI would, go for a baby step. Means that if at all they have to, go for a rate cut, they will start with 25 basis point. And then, as I said, I mean, ultimately, they will watch for the data and depending on the data and the trajectory, expected trajectory of these indicators, they will decide whether to step it up or go slow.
Okay. Let's get Mr. Pan also on that as well to help us understand if the rate cut in February is still expected. I mean, like while the domestic macros we are discussing definitely warrant it, but the global macros are making it a harder decision. What is your expectation, sir?
No, so as I said, that the growth inflation challenge needs to be very rightly understood by the Reserve Bank of India. And as Sunil also pointed out, that there is still inflation worry domestically. We have seen about 5.5% last number. Our own estimate is another 5.5 or 5.4% in the next month. Therefore, the pace at which the inflation goes down could be a bit of a worry, leaving aside also risks that I talked about from the currency as well as the global commodity market cycle. So, all that taken into consideration, I think February is possibly not the best time for the Reserve Bank to start cutting rates, given that we are also seeing a depreciation trend in terms of the currency. So that is I think the most important bit to me. In terms of the timing, I think it's very difficult. I'm not sure even if RBI knows about the timing. So every policy is live from this point in time. And as of now, what I have been conveying to my clients is that April is possibly be a right time. But once again, the extent or the depth of the cut could be quite limited to just about 50 to 75 basis points. And unless the other sort of structures of the economy are taken for the entire for the cycle as a whole, for the entire year, therefore, and unless I think the structure and unless inflation is controlled, and I think the RBI was very clear about it in the policy statement also, that inflation hurts consumption to a very significant extent, and unless inflation comes down, you can't expect the private consumption expenditure to actually grow. So that's the balancing act that the RBI needs to undertake in this in the policies, not only in February but all policies going ahead.
Mr. Sinha, Mr. Pan did talk about his own expectation on inflationary front, 5.5 to 5.4% going after that. What is your own understanding of where are we going to see inflation headed from here?
Well, I mean, inflation has behaved, somewhat not on the expected lines. And now that we are in the winter months, where the typically, due to seasonality, the vegetable prices really come down significantly. But unfortunately, now we are almost going to end December, and still the vegetable inflation is very high. So by and large, the pressure to the retail inflation is coming from food items. And that has been a trend for now more than a year. And although the Rabi crop appears to be okay, but we really don't know how the weather would behave going forward. So much would depend on the weather in terms of what kind of a harvest we will get out of this forthcoming Rabi crop. So all of these things are very much important in terms of really looking at the overall retail inflation. And my own assessment again is that even in the next fiscal, I mean, the overall inflation is unlikely to come down to the target level of 4%. It will still remain a little above, close to a 5, a little above 5%. I mean, taking into consideration all the geopolitical situation, as well as assuming that, the Rabi harvest remains on the expected lines. So net, the challenge remains on the inflation front.
Net challenge remain on the inflation front. Mr. Pan, I'll come to the closing comments to both of you now. One, on your growth front target, what could that be for the year 2025? What are you penciling in? And also just a word on the new incoming RBI governor. Do you expect him to look at things in a different way? Although things are turning out to be more difficult than they were probably 6 months ago, but how is it that you expect him to approach the policy statement now?
Well, I think as in terms of the growth, we are penciling in a 6.1 to 6.2% for the current financial year, going up to 6.5% for the next financial year, hoping about two things. One is that the monetary policy will sort of react on the downside and rates will be cut. That's number one. And the number two, which is a very aspirational sort of perspective that we are taking, is that given the fact that the room for monetary policy to sort of boost growth is limited at this point in time, we are not really expecting a very significant tightening further in terms of or a consolidation further in terms of the fiscal. And a clear message from there should be coming out in terms of how the government also continues to spend, and that will help in the growth perspective. On the RBI governor, I think obviously he has said he'll do what is the right thing. And I think, as I have been sort of looking at or talking about this on the show, the growth inflation balance is something that the RBI is critically looking at. And I'm not sure whether the RBI will be moving itself away from all the financial stability aspects that the RBI had been implementing till now, and which has to a certain extent been instrumental in reducing credit growth and therefore reducing the growth aspects. So I think therefore we should be expecting the right sort of judgments that would possibly be taken. And it's not about one RBI governor or the other. It's about the country as a whole. And that's where I'll rest my point.
Okay, Mr. Sinha, same question to you. Growth expectations as well as how the policy will take shape under the new governor.
Well, so far as GDP growth is concerned, my expectation is almost similar to what RBI has put it out in the public domain for the current fiscal, which is 6.5%. And next fiscal also, I believe the growth would be somewhere around 6.3, 6.4%, not more than that. So that, so far as expectation about the GDP growth is concerned. Now, with respect to the new RBI governor, I believe that ultimately it is the institution called RBI, which is, of course, headed by the RBI governor, but they do take input from different divisions, and also there are monetary policy committee members. Their input will also come in. So net, my own assessment is that the situation would be looked into more from, creating a right balance, which can not only, effectively, accommodate or fight the inflation, but at the same time will not hurt the growth. So the growth inflation balance, in my view, will be more important for the incoming RBI governor, rather than simply thinking about that when to go for the rate cut.
Point taken. Well, both the economists almost on the same page right there. Well, thank you so much, Mr. Pan, and thank you so much, Mr. Sinha, for sharing such important insight on this very important topic right there with all our viewers. We'll wait and watch to find out as to how things progress from here, and we'll be hoping to have you back to get us a greater understanding and a deeper understanding into the way the macroeconomic trends are shaping up. Thank you so much for being with us.